Welcome to vTalkInsight, Market Drivers Daily for August 20th, 2026. Long-term Treasury yields are back near their recent highs, just as AI capital spending and U.S. deficits collide. That combination is forcing a rethink of what counts as a safe asset, where equities can still re-rate, and how long policymakers can lean on financial engineering instead of fundamental adjustment. Long-term yields remain the hinge for almost every other macro decision. After the brief rally triggered by yesterday's buyback headlines, the U.S. 30-year is again trading above 5% and retesting the 5.3 zone seen earlier this month. Markets are increasingly treating the 4 to 5% range on the long end as the new normal rather than a shock, and term premia are rebuilding around that level. The underlying drivers have not changed. Large and persistent fiscal deficits, heavy Treasury and corporate issuance, and investors demanding higher compensation for duration risk are all pushing term premia higher. Recent buybacks of 10 to 30-year paper, even with individual operations set to double toward $4 billion, are widely viewed as emergency steps that cannot offset a $40 trillion debt stock and a still rising issuance path. That backdrop is reshaping cross-asset pricing. Long bond yields near their highest levels since 2007 are making treasuries a more credible income hedge, with 10-year yields in the mid-4% area and 30-year yields above 5%. At the same time, credit spreads over treasuries have compressed to their tightest levels in decades, so high-grade corporate bonds no longer look obviously cheap on a risk-reward basis for many allocators. Higher yields are also starting to bite in risk assets. Tech-heavy indices, such as the Nasdaq and rate-sensitive housing stocks, are under pressure as mortgage rates revisit their highs of the past year, and funding costs rise across the curve. Market commentary highlights a key line in the sand around 4.75% on the 10-year. A sustained break above that range could challenge broader equity valuations and drive a rotation toward more defensive sectors. The counter-argument is that if inflation settles and growth cools, the adjustment could come more from lower front-end rates than from another spike in the long end. In that scenario, curve steepening would reflect eventual Fed accommodation of higher issuance, not a loss of control. For now, the dominant story is persistent upward pressure on long yields, with investors watching 10-year moves around the 4.5 to 5% band, Treasury refunding plans, and stress in rate-sensitive sectors. The next question is who is demanding all this capital at higher yields, and that takes us directly into the AI-driven investment cycle. The AI build-out has moved from a niche growth story to a macro force in its own right. U.S. earnings momentum remains strong, with high margins helped by automation and AI adoption, while Europe is seeing broad-based earnings strength in energy, industrials tied to data center demand, pharmaceuticals, and banks. That resilience is one reason equities have so far absorbed higher yields better than in previous cycles, even as policy stays in a higher for longer mode. Beneath the surface, AI is also a major source of new bond supply. August investment-grade issuance hit record levels, with hyperscalers and chip makers issuing heavily to fund data centers and infrastructure. Broadcom's efforts to arrange more than $60 billion of financing for AI chip initiatives, along with significant borrowing from other hardware and cloud names, adds to the same pool of duration that investors must absorb, directly competing with sovereign borrowing needs. On the revenue side, the growth story remains powerful. OpenAI's enterprise business has reportedly grown about 50% so far this quarter, with its coding revenues more than tripling to around $20 million. Meta is spending hundreds of millions of dollars a year on Microsoft's Azure AI, while Chinese models have rapidly closed the performance gap and are now being adopted by U.S. platforms such as Airbnb and DoorDash, underscoring intensifying global competition. AI adoption is also spreading across the old economy. Roughly 3/4 of companies are reporting positive returns on AI projects, and boardrooms in traditional sectors are now demanding concrete AI strategies. Examples range from Deere's push into precision agriculture with attractive payback periods to IKEA using AI to move staff from customer support into a billion-dollar interior design business. Some emerging markets are benefiting as AI supply chains and data center investment diversify beyond the U.S. and Europe. Set against that optimism are growing medium-term risks. Forecasts suggest AI capital spending growth could slow by around 2027, pressuring suppliers' earnings and U.S. profit margins just as debt loads peak. Concentration risk is high, with much of today's AI revenue clustered in a few cloud and hardware providers, while data center overcapacity or humanoid robotics disappointment could erode expected returns. Regulators are paying attention, from the Fed warning that AI investment might fuel inflation or financial instability, to the CFTC exploring AI compute futures. That mix of strong growth today and more uncertain economics later feeds straight into concerns about how sustainable the current fiscal and funding trajectory really is. Fiscal arithmetic is increasingly the silent partner in every discussion about yields and AI. U.S. public debt has moved past $40 trillion, roughly doubling over the past decade, and now sitting around 100% of GDP. Interest costs have become the third largest line item in the federal budget and take about 1/5 of federal revenues, leaving far less room for policy mistakes as rates remain elevated. The annual deficit, still close to 6% of GDP even after a decline from roughly 8% last year, is driven mainly by structural factors. Entitlement programs account for more than 2/3 of federal spending, and political gridlock makes significant reform difficult, with unresolved issues such as Social Security sustainability lingering in the background. Temporary drivers like tariff refunds and accelerated expensing of capital investments may fade, but without broader consolidation, debt dynamics remain challenging. Recent Treasury actions show how fiscal strain is shaping market strategy. Authorities plan to at least double buybacks of 10 to 30-year bonds while leaning more on short-term bills, which now account for around 23% of marketable debt, above many recommended ranges. Foreign central bank holdings have fallen, shifting the burden to more price-sensitive private investors and raising the risk of buyer fatigue or outright strikes. That combination has stoked worries about fiscal dominance and comparisons with Japan-style yield control, alongside expectations that a weaker dollar and some degree of financial repression could emerge over time. Gold's appeal is reinforced by sustained central bank and consumer demand and by its role as a hedge against long-run currency debasement. A more constructive view highlights that some deficit drivers are temporary and that a renewed focus on fiscal consolidation, spanning both revenues and spending, is being prepared. From that angle, today's higher-term premia are a market signal rather than a crisis, and long-end yields could stabilize if inflation stays contained and growth slows. Even so, the balance of evidence points to fiscal risks keeping upward pressure on borrowing costs and shaping global capital flows. Key signposts now include concrete policy proposals out of Washington, the mix of future Treasury issuance, rating agency commentary, forward demand for U.S. debt, and the paths of the dollar and gold, together with AI capital spending plans and long-dated yield levels. These factors will determine whether the current high-yield equilibrium proves durable or is simply a staging point for the next repricing. To wrap up, long-dated U.S. yields remain in the driver's seat, with Treasury interventions, AI-driven issuance, and unresolved fiscal deficits all contributing to a higher-for-longer rate structure. That environment is supporting more compelling income and quality fixed income, but also tightening the screws on long-duration equities and on policy credibility. Monitoring how AI, capital spending, concrete fiscal plans, and future Fed signals evolve from here will be central to understanding cross-asset risk and return. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.